Today we have a lot of different content and panel discussions. We will start with a really interesting one about banks and institutionals and if they are FOMOing about offering crypto services. Now, what should they do? How can they retain their clients or gain new clients? Is it more than just a marketing stunt, or can they actually change their business model to really grow and retain users in the future? Of course, their business model clashes with the ethos of cryptocurrencies, of open, permissionless, and decentralization and censorship resistance. But we will see what they have to talk about today. Will they be able to give up control? In the end, today we will be talking with Ian Taylor from Crypto UK and panelists from Metal Payments, Kraken, and the Bank of Lithuania. The floor is yours.
Thank you very much. Good morning, everybody. Thank you so much for joining our panel this morning, the first on crypto. We're honored to be here. In light of the fact we only have 30 minutes, we'll dispense with long introductions, so we'll get straight into the meat of the discussion. Centralized entities such as banks have long controlled the money system and the financial market infrastructure that coexist supporting these central-based systems. The advent of blockchain technology and decentralized infrastructure, which is based on peer-to-peer transactional relationships that exist in a trustless system, has most certainly caught the eye of the old guard. Therefore, it is no surprise that typically we've seen many of the major banks either develop crypto-related products, such as custody or wealth, or are considering proof of concepts internally. In this session, we will look at the rise of crypto legitimacy in traditional financial services. How far will financial institutions go to keep their monopoly? Is offering crypto services the latest step in banks' effort to keep their grip on our money? And what does it mean for the world of crypto to have the stamp of approval from banks? All right, so let's move to our first question, which I'm going to pose to Simonas, a central banker from the Bank of Lithuania. So as a central banker, at a forward-thinking institution when it comes to digital payments, can you discuss how Lithuania currently regulates the sector and some of the issues, challenges, and opportunities you see in the payment space with regards to this new technology?
Thank you, and good morning, everybody. So the Bank of Lithuania is a consolidated supervisor and supervising the traditional financial sector for now. And we are responsible for the whole financial sector, insurance, payments, and banking, of course. And currently, and probably as in most countries, the regulation and supervision of crypto and traditional financial sector is separate. But I guess it's pretty much sure that in a couple of years' time, it will be emerge in terms of regulations and supervisions, and MiCA regulation in Europe is definitely the game changer. So now we are preparing for that. I think we need both us and the community to prepare, because if you fail to prepare to fail, and we take it seriously. And in transition period, we try to step up with the regulation and reinforce the compliance on AML, governance, and KYC and other issues, because I think that will be very important issues in terms of regulation in a couple of years' time for the crypto sector. And turning to challenges and opportunities, of course. So I guess it's no question that the crypto sector has a huge potential to develop. But I think for that, key trust enhancements should be made in several areas. First of all, I think on social dimension. I think if the crypto sector wants to be much more broadly accepted, I guess there should be some more trust between the wider community and the crypto sector. And stable coins should be stable coins and things like that. Technological trust, I think that's another big step where I think there should be some improvements. Proof of work concept, that's very safe, but not so efficient. And I think capacity, speed, and things like the environmental dimension, I think here is much needed way forward. And last but not least, regulatory trust. And here, of course, the traffic goes both ways. And we regulators need to better understand the sector. But I guess the sector needs to be quite bold and sometimes even volunteer for stricter regulation than traditional financial sector, and to show that new technologies can do, KYC and other issues even better. So trust on the social dimension, on the technological, and on the regulatory, I think, are the key features for crypto sector to be successful in the future.
And may I ask a follow-up question, if I may, regarding how many licenses you guys have issued to crypto companies? And I ask this question, you may not be able to answer, but in the UK, which is naturally where I'm from, running Crypto UK, the FCA, regulator, gave out just over 30 licenses for the money laundering regime, which is the first piece of regulation in the UK, when we know over 100 applications were received. And how are you guys working with the industry? Can you answer how many licenses you?
So for now, we are not issuing the crypto licensing. So we are responsible for the traditional financial system, and we have a huge community of e-money institutions, so more than 160 in Lithuania, and we experience and working on that. On the crypto exchanges, our FIU, Financial Intelligence Unit, is responsible for the supervision. But I would say we don't really have a real licensing, environment in Lithuania. And I think MiCA regulation that will bring on, and definitely then we traditional supervisors will be responsible for licensing. And I think this preparations is very important for now, because now we have 400 crypto exchanges in Lithuania, which is a big number for our country, and I think. Moving them to proper licensing when MiCA comes, I think it will be a challenge both for us and the community. And in between, very close dialogue and mutual, understanding and more trust. I think that's very important.
Great. And just for the audience, MiCA is markets in crypto assets. So this will be the European-wide regulation that you will welcome when it comes into legality next year, I believe. All right, let's move the question on to Curtis at Kraken. Following on from the discussions on policy and regulation, as the managing director at Kraken, a top-tier crypto trading venue, you must be faced with many jurisdictional questions as to where to set up, get regulated, for etc. Can you talk to which jurisdictions, in your view, have got it right, and perhaps give your view on how Kraken thinks about achieving balanced and proportionate regulation for the sector?
Thanks, Ian. First off, I love that you asked that question in the context of balanced regulation. I think a lot of times the discussion ends up being, what's good regulation? What's bad regulation? And I suspect, especially in this context here at Money 2020, like what's good for crypto may be considered bad by incumbents and vice versa. And so it's really important for us to focus on what balanced actually means. I think Kraken takes the approach that balanced regulation, it exists, but it basically is trying to manage the tension between three often opposing forces. How do you protect people, which is consumers? How do you protect participants? And how do you protect the opportunity of the technology itself? Usually, the tension exists between the first and the third. How do you create sufficiently forceful and firm regulation to protect people, not necessarily waiting, perhaps, for bad things to occur, and to preemptively define regulatory perimeters without stifling or constraining the opportunity of the technology. But really, just kind of ticking through the three, it tends to be, I think, currently heavily emphasized by both the regulatory community as well as industry participants that we do have to protect consumers. This was probably the biggest lesson that came after this last bull cycle, and it is fun that we're talking about this right now in a bear market cycle. This is really when the consolidations happen. This is when the frauds and the scammers tend to disappear because they've run out of cash. This is when the industry starts to work very closely with regulators that are keen to make good regulation a reality. The second bit, though, protecting participants, this is, I think, where Kraken and other exchanges have seen the most area for growth, which is to say, it's all fine to create dedicated policy frameworks for crypto exchanges to operate, but there has to be some teeth behind it. You have to actually reward or recognize the benefits of participating in a regulated regime. It comes with a lot of trade-offs: compliance, reporting, the level of transparency that is really currently only provided by banks. There's really only a few exchanges that are able and well-resourced sufficiently to participate in these kinds of regimes. And so it's difficult to compete with offshore exchanges, where this onshore-offshore dynamic is increasingly becoming felt. Why do you want to get regulated if you can offer your entire product suite from offshore? There are many jurisdictions that are challenged to get this right. And then, of course, not wanting to stifle the opportunity of technology. I think that's really been well discussed in past forums as well. So when we're looking at balance, what are some of the jurisdictions we see that are getting all three of these dimensions right? I think it's great that we can point to a few. The first one is probably the Financial Services and Regulatory Authority in the UAE. We've been working with the ADGM and the FSRA, the Supervisory Authority in the Abu Dhabi global market, for about 3 years now. And a lot of that has to do with building up the trust and the dialogue required to put together a regulatory framework that actually protects people. It rewards and protects participants who choose to come on shore and compete on a level playing field. And it also remains sufficiently open-ended that technology is not constrained as new innovations occur. Another one, frankly, Ian, and I'm not going to emphasize this too much because you and I are both in the UK, but after participating in some of the recent UK Financial Conduct Authority sponsored activities with the industry, I'm quite encouraged by some of the signals that are coming out of the UK as well.
Thank you, Curtis. That's good to hear regarding the FCA. And just a follow-up question. Kraken and a handful of others have been compliant first in terms of working with policymakers in this largely unregulated sector. There are a number of trading venues that haven't been compliant first as a strategy for many reasons. Do you see this changing, and will we see consolidation with a number of trading venues that exist in regards to the onshore-offshore point you made?
Yeah, it's really interesting, right? Like, this topic is about crypto FOMO, the banks feeling FOMO. What exactly are they afraid of missing out on? I think this topic is quite different, talking in a bear market, because the real FOMO should be felt by exchanges and new providers, participants, who are perhaps a little late to recognize that adoption means more regulation. If anything, we're headed towards a world where regulation is going to be the norm for crypto participants. And with regulation comes, I had previously mentioned, a lot of back office, a lot of compliance reporting obligations that require intensive capital. So really the question is, who benefits most in a regulated environment? It's actually the traditional players who have built up, after tens of years, the ability to operate in a regulated context. If anything, the FOMO is felt, especially as the market is down, by exchanges who may not be able to compete when regulation is the norm. Mm-hmm. And so I think it's very relevant for us to be talking about this.
Yeah, and there's an economic cost to being compliant and being regulated. All right, so let's move the next question on to Irina, the CFO at MetalPay. A hot topic right now, stablecoins. Most folks will be aware of some issues that have taken place in decentralized or so-called algorithmic stablecoins. Well, what I'm going to ask Irina is, these events recently, whether it be policy discussions or issues that we've seen with certain stablecoins, have raised many questions from many stakeholders within the ecosystem. What are you, as the CEO of a well-known crypto payments platform, bridging fiat and the crypto worlds, where do you see the future path of regulation? And perhaps touch on centralized versus decentralized stablecoins and where you would like to see that evolve.
So first of all, it's important to acknowledge that stablecoins have to be taken seriously, have to be done right. They are the layer over the traditional finance that are providing a lot of benefits to the world. The vice chair of the Federal Reserve in the US recently said that the stablecoins is the way for entrepreneurs and users around the world who rely on the stability of the US dollar to participate in that economy. So in order for that to happen, the banks really have to embrace the regulation and, of course, have to embrace the technology behind stablecoin, and that's going to be a very hard lift for them. So we believe in reserve-backed stablecoins, and we think that maybe down the road it's also going to be a basket of stablecoins that is going to be issued by various banks. You know, we have multiple banks in the US, there are multiple banks in Europe. Does each bank need to issue their own stablecoin, or should there be just one that the basket contains of each bank from different countries? We think that that's where the regulation and the technology of it is going, and this is definitely not to be ignored.
Thank you. And perhaps in terms of, if I could bring in Simonas here, as somebody who works at a central bank, do you see a world where a stable coin doesn't have any backing in terms of an uncollateralized stable coin? What's your view around how that model should work?
Well, probably not in the near future, to be honest. And but I think the main principle for good regulation is, same risks, same regulation. Mm-hmm. And if a stable coin wants to be real stable, trusted by wider community, and stable in the long run, I think some features like deposits or e-money should be applied to stable coins. And history shows that from time to time we have runs on private money. And we need some backing to avoid that. So we need liquidity assistance, what kind of liquidity system we can have for stable coins, but that's, I think, very important to be reinforced. We need transparency and reporting, what is behind, reserves and how they are kept, and we still, I think, lacking that a little bit in the market. Without that, I think it's quite difficult. And I mean, we had the history, 100 years showed that, all the problems where we don't have liquidity support, when we don't have enough regulation and trust, from time to time, bad things happen. So crypto community now has a chance to preemptively, apply some good regulation before really bad things happen. And I really wish that for all us, of course, regulators and the market.
Yeah, and for me personally, the work we do with governments and policymakers it's very exciting, the opportunities that payment systems and architecture have for providing a different payment infrastructure that's separate from the current infrastructure, just in case of a low-tail risk event, a black swan event, but at the balance of protecting against financial stability, as you'll be well aware of, and protecting consumers. And jurisdictionally, to your point, different regulators are looking at this differently. Should it be regulated under payment regulation, or should stablecoin issues be regulated as financial institutions like banks, which is a much heavier regulatory requirement? But it will be fascinating how this plays out. So let's move on to our next question. And I'm going to open this up to the panel. So compared to traditional financial systems, DeFi, or decentralized finance, promises to increase security, efficiency, transparency, accessibility, openness, and interoperability for financial services. DeFi has the potential to lower financial audit costs and substantial opportunities for financial integration across borders. The traditional financial service providers appear to be waking up to this fact. And this newly emerging form of autonomous financial intermediation in a decentralized, digital-empowered environment using smart contracts on public blockchains is a huge disruptor. I wonder if institutions, TradFi, are now acknowledging this, and where do we see implementation within banks of this new area? Irina, would you like to kick off?
Sure. I think this is kind of the meat of this panel, and this is where I see the real FOMO comes in. And it's not necessarily the FOMO between crypto companies and banks, but it's the FOMO between banks and banks. and which one of them is going to be ahead of the game when it comes to DeFi. Because DeFi, it has to do with finance, but it's first and foremost technology. So there are developers all over the world in their garage developing DeFi products every day. DeFi exchanges, DeFi KYC, DeFi lending, DeFi identity, and all of those products, to be fair to the bankers in the audience, some of them are better than the banking products that people have access to. But they are limited to the extent that their regulation hasn't caught up with the DeFi. And to Curtis's point, it does take a lot of effort, funding, knowledge to get this kind of regulation. So which one of these DeFis will the banks embrace? And which one of the banks are going to be ahead of the game so the rest of them will have FOMO? And I think that the most important thing for banks to look at is to partner with a DeFi product that has the ability to integrate things like KYC, things like regulation, AML. If there's different kinds of licensing for exchanges versus lending, which one of the DeFi products can integrate it with the help of the bank that already has had for years the financial system and the experience to process these transactions.
Curtis, can I bring you in on this question? So can I ask, do you at Kraken talk to traditional finance with regards to DeFi? Do they want in? Do they want to get involved in the high yields that some of these protocols provide? Or are they scared of source of funds and liquidity pools being compliant?
Yeah, we talk to banks all the time about this topic. We are not used to, as a society, living in a world where borders don't meet borders, which is to say, we are uncomfortable, especially as a financial society, with this notion of demarcated zones, which is to say, like, you've got the border of a bank's service here, you've got the border of a provider's service here, and then there's all this stuff in the middle. That's where DeFi is. And so I think a lot of the conversation right now is, sure, there's this intermediation that happens when a particular set of transactions or a user, a person, an avatar, leaves a particular service, and before he or she looks to re-intermediate, performs a bunch of transactions in the middle. The question is really, how do we manage a world where there's increasingly amount of space between the service borders of centralized providers? But the reality is, people are always going to come back in. People are always going to have to re-intermediate at some point, even if it's just a cash out. And I think this is something that was fascinating to discuss at the UK Crypto Sprint a couple of weeks ago, because there was a tremendous amount of focus on how do we regulate DeFi. I think the question is really, how do we create a common system, a common set of standards that allow people to disintermediate, then re-intermediate? Almost like one of those Star Trek teleportation devices. Like, how do you reassemble the person that's behind the transaction when they bounce from service area to service area? Because you know that they're going to perform disintermediate transactions in the middle. I think that's the conversation right now. It's a good one.
We should ask Scotty. He's the engineer on Starship Enterprise. Just following on from that, regulation and policymakers have a difficult job because traditional regulation is based on central actors. And in DeFi, that model is just thrown out of the water. So we have this new paradigm, which is both exciting, but also can be fraught with issues, such as consumer harms and so on and so forth. Simon, how do you feel as a policymaker, what's the right balance between balancing protecting against consumer harms and financial stability, but also allowing the innovation to grow and provide better use cases for consumers?
Well, I tend to believe, to agree with Irina that DeFi is first and foremost technology, and for regulators, I think it's very important. Same risk, same regulation, but also agnostics to technology. And from my point of view, I think we should shift more from institution-based regulation and supervision to activity-based. And actually, that is happening a little bit. For example, in consumer lending or mortgage lending, it's more approach is going to the activity-based regulation and supervision. So I think this principle should and could possibly could be also applied to DeFi. And we as a regulator should look, what kind of services are, consumers getting in terms of DeFi? Is it, consumer lending or payments? And then, the regulations should come from that angle, including, of course, the consumer protection, which is also, very similar as in the traditional financial services. So if we look from this kind of perspective, then I think the picture is getting a little bit more simple.
Thank you very much. Okay, so we have time for one more question, I believe. So let's get our crystal balls out, shall we, panel? In the medium-term horizon, say 5 to 10 years, where does the panel see blockchain and Web3 applications embedding themselves into society and perhaps focus on interoperability with existing systems, or perhaps will we see some of this technology replace the existing systems? Who would like to kick off?
I can go. I guess with banking, I sometimes compare it to the telecom industry. So the telecom industry switched to being a technology industry. It used to be not very, sexy for a developer to go work for, AT&T or something. But now, they become a technology companies, and they're hiring more developers than perhaps, something like Google and Microsoft. So I see that becoming banks. Banks will become technology companies, and technology companies will be more and more integrated into banks. And it's going to be very interoperable in between the two.
Thank you. Curtis, you got any comments?
I think we're going to see the rise of some new economies that we didn't anticipate. So if you think about Web 2, what Web 2 created was a service economy that didn't exist prior to, with the onset of two-sided market service providers. I think similarly with Web 3, you're going to start to see an increasing number of creator economies that are able to operate much more freely than they are today. Why do you need to create your content and wait to get paid by some centralized, archaic, video content platform? Why do you have to take a check and take it to your bank in order to cash out your earnings when you could do all of it online? I think you're going to see a tremendous amount of seamlessness in the creator economies that exist on Web3.
Yeah, Web3, read, write, and own, community-driven. Go ahead,
Well,
Simon.
of course, I agree with the sector that the potential is here. And I think, but I would like to get back to the trust thing. And I think here we need to go further. And basically, the crypto world was born because people were not trusting enough the traditional financial sector in the global financial sector, global financial crisis. But now I think the cycle has turned. And we at the doorstep of crypto sector making a leap towards better trust on social dimension, on technological dimension, and on the regulatory dimension. And if all these dimensions are covered, I think then, of course, the potential could materialize because the technology is there.
All right, folks, so a couple of sound bites. I think join your local trade association, go and speak to your parliamentarian. Activity-based regulation is what we need to let this new sector flourish, and banks will become data companies. I think we've already seen that with the JP Morgan announcement of some 14 billion or so invested in technology. So all that remains is, if you'd like to join me in a round of applause for our panel. Thank you very much.